Hello everyone, in this video we are going to do the topic adjustment of partners capital. We have already done this topic in admission as well, how when a partner comes in or goes out the remaining partners capitals and profits changes. Okay, that's we are going to study here. So at the time of retirement or death of a partner, the remaining partners may decide to adjust their capital contribution in their profit sharing ratio. In such a situation, the sum of balances in the capitals of continuing partners may be treated as total capital of the new firm unless specified otherwise. So, then to ascertain the new capital of the continuing partners, the total capital of the firm is divided amongst the remaining partners as per the new profit sharing ratio, and excess or deficiency of capital in the individual capital amount may be worked out. Such excess or shortage shall be adjusted by withdrawal or contribution in the cash as the case may be, or can be done by current account, opening current account as well. So let's look at our illustrations number 14 to 17, which are starting from page number 194 onwards of our NCERT book. So 14th, Mohit, Neeraj and Sohan are partners in a firm sharing profits in the ratio of 2:1:1. Neeraj retires and Mohit and Sohan decided that the capital of the new firm will be fixed at rupees 1,20,000. The capital accounts of Mohit and Sohan show a credit balance of rupees 82,000. So it's a credit balance and 41,000 respectively. After making all adjustments, calculate the actual cash to be paid off or to be bought in by the continuing partner to pass the necessary journal entries. The new profit sharing ratio is given, it's 2:1. Okay, how is it given? Because one of them, Neeraj is going out, the middle one is going out. If I cover the middle one, the new PSR comes 2:1. Okay, so now new capital totally, how much is the capital? 1,20,000. So new capital based on new ratio, 1,20,000 in 2:1 is 80 and 40. Existing capital is what? 82 and 41. So existing is 82 and 41, and it should be 80 and 40. So cash to be bought in, okay, or paid off. So it is paid off. 82 is the existing, needed 80, 2,000 take away. 41 is the existing, 40 is required, just 1,000 take away. It's both paid off. So when they are paying off, what is happening? Mohit's capital is getting debited, Sohan's capital is getting debited, and cash is getting credited. Okay. Now, illustration 15. Asha, Deepa and Lata are partners in a firm sharing profits in the ratio of 3:2:1. Deepa retires, the middle one retires, after making all the adjustments relating to the revaluation, goodwill and accumulated profits, etc. The capital account of Asha and Lata showed a credit balance of 160 and 80 respectively. It was decided to adjust the capitals of Asha and Lata in the new profit sharing ratio. You are required to calculate the new capital of the partners and record necessary journal entries for bringing in or withdrawal of the cash. So calculation of new capital of the existing partners, balance in Asha 1,60,000, balance in Lata 80,000. So total capital of the firm is 2,40,000. What is the new profit sharing ratio? The middle one is going, so 3:1 is the new profit sharing ratio. So Asha's new capital is 2,40,000 into 3/4, 180, and her is 60. Let's see. She needs to bring in 20,000. She needs to take out 20,000. So the total capital of the new firm is based on the sum of balance in the capital accounts of the continuing partner. New capitals required this much, existing this much. She needs to bring 20. She needs to take out 20. So the journal entries, Asha is bringing in 20 bank to Asha's capital, and Lata is taking out 20,000 Lata's capital to bank account. When the amount payable to retiring partner will be contributed by continuing partner in such a way that their capitals are adjusted proportionately to the new PSR. Now, illustration 16, let's see. Lalit, Pankaj and Rahul are partners sharing profits in the ratio 4:3:3. After all adjustments on Lalit's retirement, the first one is retiring, okay, with respect to general reserve, goodwill, revaluation, the balances in their capital accounts stood at 70,000, 60,000 and 50,000. It was decided the amount payable to Lalit will be bought by Pankaj and Rahul in such a way as to make their capitals proportionate to the new profit sharing ratio. So what is happening? They don't want to part away with firm's money. So the continuing partner, they decided, okay, we have to pay 70,000 to him. We both bring 70,000. And we both bring 70,000 in such a way that afterwards, okay, we are bringing money, so our capital will obviously increase. Our capital should be in such a way that they are in profit sharing ratio. So, calculate the amount to be bought in by Pankaj and Rahul and record necessary journal entries for the same. Also record necessary entry for payment to Lalit. After Lalit's retirement, the new profit sharing ratio between Pankaj is 3:3, that is 1:1. So let's find out what should be the total new capital of the firm. So balance in Pankaj 60, balance in Rahul 50. So 60 plus 50 plus they are going to bring what? How much? 70,000 they are going to bring. Whatever is the ratio, but in total 70,000 is coming into the firm. So that will also become firm's capital. So the total capital of the firm becomes 1,80,000. That 1,80,000 should be equally, so half and half, so 90 and 90 should be there. So see, his capital should be 90, his capital is right now 60, so he needs to bring in 30. Even his capital should be 90, his capital is right now 50, so he needs to bring 40. So he's bringing 30, he's bringing 40. Okay, 70,000 is coming into the firm. Okay? Yes, 30 and 40. So, bank to Pankaj capital to Rahul capital, total 70,000 coming in, 30 and 40, and that 70,000 is being paid to Lalit. Okay, and the last illustration for this lecture is illustration number 17. Okay, and this is the type of questions we generally expect in exam as well. So the balance sheet of Mohit, Neeraj and Sohan, who are partners in a firm, sharing profits according to their capitals as on March 31, 2017 was as under: creditors, Mohit, Neeraj and Sohan's capital, also general reserve. Building machinery stock data is less provision and cash at bank. On the date, Neeraj decided to retire from the firm. Who is retiring? The middle one is retiring, yes. Okay. And was paid for his share in the firm subject to the following: building to be appreciated by 20%, provision for bad debts to be increased to 15%, machinery to be depreciated by 20%, goodwill of the firm is valued at 72,000 and the retiring partner's share is adjusted through the capital accounts of remaining partners. Okay. The capital of the new firm is also fixed at 1,20,000. Okay. So, prepare revaluation account, partners capital and balance sheet. So, we know building is the only thing which is increasing, rest these two are provision and unrecorded liability is coming in and machinery is going down. So, the balance profit is distributed amongst all the old partners in the old ratio. Here what we have done, we have brought down the capital balances, we have also given the general reserve to them, okay, and the profit on revaluation. Now, the goodwill, we calculated his share of goodwill, okay, working notes. So, new capitals, okay, yeah, we calculated his share of goodwill. Neeraj is getting 18,000, who is giving in the gaining ratio 2:1, 12 and 6, so whatever is the balance carried down. Now, do remember why we are doing balance carried down even of Neeraj, because we need to know one thing, that after his retirement the total capital of the firm is to be 1,20,000. So how that 1,20,000 will be there? So balance brought down. Now, see, we need to know what is the total capital. So he will be paid out of bank, but see, his capital was 82,000 and his capital was 41,000. We wanted this to be in 1,20,000 fixed, that too in the new ratio, that comes to 80 and 40. So he is going to take out 2, he is going to take out 1, and accordingly the balance sheet, okay. Why bank overdraft came? Because here he has been given 65,000. We did not have that much cash. How much cash we had, we'll just see in the bank account. So balance was this was is the carried down, see, this much is to be paid to him, this much is to be paid to him, this much is to be paid to him. So this becomes our balance overdraft. Okay. We can assume loan account as well, there is no problem, nothing is mentioned in the question. It is assumed that bank overdraft is taken to pay the retiring partner, and how much cash we already did. With this, we are finishing with this lecture. Thank you for watching.